there is likely to be a deficiency in the quantity of gold. So the report that they've got, what, 8,130 tons, or whatever the current figure is likely to be incorrect. And it's not just because it hasn't been audited properly. I mean, you have to bear in mind that really from the sort of early 80s, when the LBMA really started going, gold was the basis of the carry trade in order to buy US T-bills. And so, you would go and lease gold, say, from a central bank, sell it into the market, apply the proceeds to T-bills, and so your cost of funding was roughly 1%, and the return you were getting was up to 10%. And you leverage it up if you can, absolutely. I mean, this was a brilliant trade. But what happens to the gold? It goes into the market. Does it ever come back? Well, not really. That's the trouble. There are two aspects. In that article, I showed how the gold price, if you like, moved very similarly to how it moved in Germany after the First World War. And as I'm sure most of your viewers know, that culminated in a collapse of the Reichsmark. And the collapse was absolutely total. So we should, if you like, worry about why it is that the gold price is rising on the same sort of curve, if you like, as it was in the later stages of that hyperinflation. I mean, by the later stages, I mean really from about late 1921 onwards. And I mean, the answer to this is quite simple, and that is that the dollar is, if you like, in the early stages of its final life as a fiat currency. Fiat currencies always come to an end. And the reason they come to an end is that governments, the issuers, if you like, of fiat currencies, use them to supplement their taxes. And it gets to the stage where the debt is built up to such an extent that the whole thing eventually falls over. And that's roughly what we face with the dollar. And of course, because we have a global fiat currency system based on the dollar, it affects all of us everywhere. Your reference to 1929-32, of course, it was the big Wall Street crash, the bear market after the roaring 40s, roaring 20s, sorry, when you had a similar credit bubble, but this one is far bigger. Also, you had the Smoot-Hawley Tariff Act, which imposed extra prices on imported goods. This time, we've got the uncertainty because a capricious president keeps on changing the numbers. But there is no doubt that the combination of a credit bubble and trade tariffs at the top of that bubble.
What if the global monetary system is already entering its final chapter, and almost nobody realizes it? Alasdair Macleod just issued one of the most alarming warnings of his career. And this time, it's not just about higher gold and silver prices. It's about what the movement in gold and silver is telling us about the dollar, the Fed, and a system that is quietly running out of road. Central banks have spent decades leasing out gold, selling it into the market, and pretending nothing happened. Economists ignore monetary history, politicians hide the true condition of America's gold reserves, and investors assume the dollar will stay king forever. But according to Macleod, the pattern we're seeing in gold today matches the exact curve that appeared in Weimar Germany right before the currency collapsed. In this video, you'll learn why official gold reserve numbers may be fiction, why silver is breaking out even faster than gold, why the Fed's sudden shift toward easing is a red flag, and why we may be entering a financial event we have never witnessed before. Let's break down what Macleod is really warning gold and silver investors about.
It's a lethal combination. This credit bubble will pop. And the reason that we can see that the end of the fiat currency dollar is approaching is because we know what the response to the authorities will be when that bubble pops. Because a popping bubble basically means there's more risk in credit, which means that bond yields will rise, borrowing costs will rise for anyone borrowing overnight or whatever. It doesn't matter what the Fed says, the the funds rate is. I mean, that's completely immaterial. But markets look at risk and they have to price that risk, and they will price that risk in the knowledge that the purchasing power of the dollar is falling because that debt is being monetized. It's actually already being monetized because the Treasury is relying increasingly on the issuance of T-bills to fund its deficit because the cost, if you like, of funding at the long end of the yield curve is just too great for it. And it's also found that there isn't really the demand out there along the yield curve, if you like, to support the level of financing. I mean, you've got the deficit, and also you've got all the maturing debt which has to be rolled over. So there's substantial refinancing problems there. And it's being monetized. Is really what it boils down to. This is very, very bad news. Already being monetized. And then this week we had the Fed turning around and saying, no more QT. Now it's going to be QE. And we're going to knock a quarter point off the Fed funds rate. So you can see that the Fed has switched from trying to manage the inflation problem to trying to stop the economy from sliding into recession. So put all that together, you can see how the ghosts, if you like, of the Reichsbank are on the stage now. They don't really have the knowledge. And if you don't have the knowledge, you can't put two and two together. So it's the combination of that. I mean, bear in mind that the current cohort of economists, bankers, investment managers, whatever, are all trained in macroeconomics, which basically is Keynesianism. And so they don't actually understand economics. I mean, the whole of the Keynesian thing is a myth. It really is. It cuts out human action. And the idea that you can calculate and project from statistics exactly what the outcome will be is arrant nonsense. I mean, it really is. But they all, they don't have any substitute for that. That's the problem. They don't actually understand the legal position of gold either, because gold has been denied as part of the fiat dollar-led system for 54 years. But the fact of the matter is that gold is everyone's money, if you like, without counterparty risk. And it's embodied in everybody's common law. So, this is the idea that gold is just a pet rock now, or, whatever they like to call it, is just pure propaganda. And of course, everybody's fallen for it. So there's a huge, great re-education, not just of politicians, but of their advisors, which is necessary before they can really tackle the current problem. Nowadays, we sort of look back on the events of 1933, when FDR decided to, if you like, ban the ownership of gold, putting it very, very bluntly, and forcing individuals who held gold to swap it for dollars at the current gold standard, which at that time was $20.67 to the ounce. I mean, the point about it is that what he did was actually a clever way around property rights. Property rights are sacrosanct in an economy like America's. But at that time, we had an absolutely solid gold standard, which was de facto from, I think, about 1856, and de jure from the Gold Act in 1900. So there's absolutely no question that the dollar, at $20.67 was the equivalent of an ounce of gold. I mean, it was just absolutely simple. So using that basis, he forced everybody to exchange their gold for dollars. There was no confiscation. It was just an enforced swap, if you like, of property. So, of course, I mean, the fact that he subsequently devalued the dollar by 40% in 34 was, is a separate issue. I mean, that undoubtedly is what he had in mind when he forced everybody to submit their gold. So you can see that, it's a sort of if you like, it's a bit of legalese, really. I mean, the effect was the confiscation of gold, but in legal terms, it wasn't quite, if you see what I mean.
Alasdair Macleod begins with a blunt statement. The global gold market is built on numbers that likely do not reflect reality. Since the early 1980s, central banks loaned out gold to commercial banks, who sold the metal and invested the cash in high-yield U.S. treasuries. This generated huge profits, but the physical gold that left the vaults was almost never replaced. Frank Veneroso's research shows that up to half of central bank gold could be missing, leased out, or encumbered. This matters now because gold is rising for reasons that go far beyond investor demand. It's rising because the dollar, and the entire fiat system built around it, is weakening. Macleod shows that gold's current price curve mirrors the exact pattern seen in Germany's late-stage hyperinflation, where gold rose not because it gained value, but because the currency backing the system collapsed. Meanwhile, the U.S. government faces massive refinancing pressure. Debt is above $38 trillion. Long-term Treasury demand is weak. The Treasury is forced into short-term T-bill issuance because the long end is too expensive and buyers are scarce. This creates enormous rollover risk. And then comes the big shift. The Federal Reserve quietly pivoted. QT is fading. QE is coming back. Rate cuts are once again on the table, not because inflation was conquered, but because recession risk is now overwhelming the system. For Macleod, this is the clearest sign the dollar is entering its end phase as a fiat currency. Meanwhile, the actual markets are confirming the stress. Gold has surged past $4,200, reacting to expectations of renewed Fed easing. Silver recently hit $53, quietly rising 11% in 5 days. Industrial and monetary demand are combining to tighten supply faster than mines can respond. This creates a dual pressure point Macleod warns investors about. Gold reveals the system's loss of trust. Silver offers asymmetric upside during monetary stress. Macleod then attacks modern economic thinking directly. He says today's economists are trained in Keynesian models that ignore human action, ignore monetary history, and treat gold as irrelevant. But gold is not irrelevant. It is legally and historically money without counterparty risk. He also revisits 1933. He says a forced gold surrender is unlikely today because the official statutory price is $42.22 per ounce. Forcing an exchange at that rate would be theft. This means policymakers are more likely to maintain secrecy than attempt confiscation. It also explains why Treasury officials are told, "Don't ask about Fort Knox." His direct message to gold and silver investors is simple. The monetary system is breaking down in slow motion. When confidence collapses, fiat dies first, and gold and silver reprice instantly. This is not speculation. This is history repeating itself.
Um, I think it does actually inform us today. Would America do that again to its own citizens? I think not. I mean, the problem is that the gold standard, believe it or not, is at $42.22 to the ounce. So quite obviously, if the market price is $3,900 or whatever, and you're forced by executive order to exchange your gold at the rate of 42.22 to the ounce, that is actually definitely, um, uh, stealing your property. I mean, or stealing the value of your property. Anyway, so one way and another, I don't think it's so easy to do now. I know everybody thinks that, once bitten, twice shy. This has happened before, and therefore it might happen again. It might happen again. I mean, bear in mind that, we could be talking about legal niceties when it comes to the future of gold ownership. So, these clever guys will probably find some sort of way to do it if they really were determined to do it. But I also think it's not in their interest to do it. I mean, there's a Chinese proverb: "The wise man sits on the hole in the carpet," to basically hide the deficiency in his house. So that's actually what they should do, and this actually is the policy of the U.S. Treasury. I mean, you had Scott Bessent going in and saying, we're going to do we're going to look at the gold in Fort Knox, whatever. We're going to do a survey. We're going to do an audit, all that sort of stuff. Of course, as soon as he's in the Treasury, he's firmly advised, I wouldn't do that if I were you, Scott. Shut up. You have to ask yourself why. It's a sort of question of shut up. I mean, there are two possible answers to this. The first is the obvious one that the official line has been that gold is now a pet rock. It's got nothing to do with the monetary system, so don't talk about it. That's one option. The other option is that actually there is likely to be a deficiency in the quantity of gold. So the report that they've got, 8,130 tons, or whatever the current figure is likely to be incorrect. And it's not just because it hasn't been audited properly. I mean, you have to bear in mind that really from the sort of early 80s, when the LBMA really started going, gold was the basis of the carry trade in order to buy US T-bills. And so, you would go and lease gold, say, from a central bank, sell it into the market, apply the proceeds to T-bills, and so your cost of funding was roughly 1%, and the return you were getting was up to 10%. And you leverage it up if you can, absolutely. I mean, this is a brilliant trade. But what happens to the gold? It goes into the market. Does it ever come back? Well, not really. That's the trouble. And Frank Veneroso, who is the analyst who did most work on this, he was also talking to people I knew in the old days, like Terry Smeaton at the Bank of England. I mean, his sources were top flight. They really were. He reckoned that somewhere between a third and a half of all central bank gold had gone out on lease and probably disappeared, if you like, not returned. So what you have, I mean, if you open Fort Knox, you probably find a whole bunch of IOUs sitting there rather than the real stuff. And of course, the other problem is that we wonder why it was that the Federal Bank of New York, which basically stores earmarked gold for foreign central banks, was so reluctant to return as little as 300 tons of the Bundesbank's gold to it. What was it, 10 years ago or 7 years ago, whenever it was. There was and not only that, but they wouldn't let the Bundesbank look at its own property. They were denied the right to go and have a look at their gold, to check serial numbers and all the rest of it. Oh, no, can't do that. So, there's definitely some skullduggery going on there. I think that's the other reason, basically, why every Treasury Secretary is told, shut up, don't talk about it, off limits.
If Alasdair Macleod is right, we are witnessing the start of a once-in-a-century monetary reset, the moment when paper promises lose value and real money reclaims its role. The real question isn't, will gold go higher? The real question is, will you be holding real assets when confidence disappears? Now, I want to hear from you. Which metal are you stacking more, gold, silver, or both, and why? Comment below and share your strategy. If this breakdown gave you clarity on what's really happening behind the scenes, hit like, subscribe, and turn on notifications. This is Macro Edge, and we track the signals the mainstream refuses to discuss. Stay alert, stay informed, and I'll see you in the next video.